Friday, January 30th. Next Friday, we get jobs data for January, which will clarify some of what I'm about to say. Fed met this week, met on Wednesday. Mortgage rates and long-term rates continued to go down this week. They took another leg down today on release of the flash fourth quarter GDP report. Listening to the Fed, reading the Fed minutes after meetings, I'm comfortable as long as what the Fed has to say seems reasonably to conform to what the economy looks like. And the further the departure from the Fed's description of the economy and its intentions from what the economy seems to be just looking out the window, the less comfortable I am with what's taking place. And discomfort itself takes on different forms. There are times when we think the Fed's too late, when it's too early, when it's not, rates aren't high enough or aren't low enough. We have been in economic cycles since about 2000, which have defied the Fed's own internal econometric models. The Fed lives with models that make modeling the climate look straightforward. We've defied cyclical models for reasons that we don't really even very well understand. Some of it, the financial crisis, but as time goes on, more and more is this deflation business that began in Japan, is now spread to Europe for somewhat different reasons, now appears to be going global no matter what central banks do, and yet, as the Fed on Wednesday, everything's fine. We like the economy. We have job growth. We have acceleration. We have this and that and the other thing, and we're going to be patient about lifting off from zero, but we're still coming. And it's so odd relative to the actual data appearing, which is declining inflation. The reason the Fed raises an interest rate is to head off rising inflation. We have less and less flirting with deflation. The job market, the Fed should lean into so long as wages are rising, which would be inflationary, and they're not. The job market looks as though unfortunate youth, previously unemployed, taking jobs that they don't want to take because they gotta make a living somehow. Anyhow, the disconnect is profound. It's very deep. One Fed governor, one Fed regional bank president, there are 12 of them, hit the media today, James Bullard from St. Louis. The regional presidents are exceptionally uneven. There are a couple of them, Bill Dudley in New York and Eric Rosengren in Boston, that may be the best minds on the Fed. But there are regional presidents who are unfortunate. Bullard is one of them. And Bullard blabbed in a way that may have tipped the real hand of those who are really in charge of the Fed. And without really intending to, he said that, yeah, the Fed's still coming, June or July seems reasonable, got to come up off zero, zero's inappropriate for this economy, but went on to volunteer that what the Fed's worried about is bubbles, that the longer it stays at zero, the more it's distorted the financial marketplace. And he spoke specifically to a bond bubble, that bond rates are too low, and they're too low in the face of Fed tightening ahead, and that means the mortgage rates are too low, and too low in the face of Fed tightening ahead. And yet, the real data says that the U.S. housing market is going nowhere. Not new construction, not new permits, not resales of existing homes, certainly not entry-level youthful buyers, rate of home ownership falling every month, and yet the Fed's worried about an interest rate bubble. Gotta watch it. Jobs data next Friday. It's the next piece that'll describe what the economy's really up to. But it makes me uncomfortable when the Fed seems at variance from what I can see out my window. Good weekend.